well, again, it's great to have somebody with your long career span and expertise with us this morning. So I've got a whole bunch of questions for you. So I guess the first one is, where are we at with the return to the office? I want to hear what's happening here in New York and the US, like see what's happening in London and the UK, but what's happening here?
The first comment I'm going to make is, sadly, we're trailing Europe, believe it or not, in the return to office, but we're improving dramatically. The average across the country right now is about 52%. But peak days, meaning Tuesday, Wednesday, Thursday, we're about 65%. But everyone measures that against a benchmark of 100. No office building is ever 100% occupied, for a couple of reasons. One, people travel. Two, people get sick. And three, they work from clients' offices. So the benchmark should be 75 or 80. And today we're at 65, with CEOs now on balance mandating that their senior people return so that their younger folks, the millennials and the Gen Zs, will want to come back to the office.
Yeah, I don't know if you were here earlier this morning and heard what
No,
John
I was trying to get here, actually crossing the street.
Yeah. Mr. Katsimatides was making a very strong point that people need to get back in the office. And
John is right.
Yeah. So how much new office product is in the pipeline, given this backdrop?
So we've been through a spate, particularly in New York, of new product development, which we needed. We needed new development desperately. We have obsolescence in the marketplace. We think in New York, by way of definition, it's about 35 or 40 million feet of obsolescence. But we need new product because young people want light, air. They want amenities in their building. And so it was time for new product to be developed. We will probably see the peak of deliveries this year. Vacancy right now in New York is around 24%. That's going to come down over the next several years as we stop delivering new product for a period of time.
And what does corporate demand look like as we're getting to the second half of 24 now, actually. We're nearly halfway through. What does it look like?
Yeah, so look, post-COVID, we had a very difficult COVID year where demand was around 12 million feet against the 10-year average, which tends to be around 30 or 35 million. In 22, we returned to about 23 million feet, just a bit above that 24 million. That was almost at the 10-year average. This year, we'll probably come back around 20, 21, 22 million square feet. So bottom line, corporate demand is coming back. We're seeing some very large deals in the market today around the country, and in particularly in New York. And the finance and legal sector is offsetting what I think is the normalization of the TAMI sector and tech. Tech grew really far, really fast, and now it's normalizing.
Okay. What about distressed assets? What are the critical factors there to think about?
Yeah, so this is a part of a larger conversation, which is with interest rates now and the Fed fund rate being around 5.3%. I haven't checked this morning, so for those of you who are better informed, let me know. But we expect to see normalization of interest rates, probably end up around 4%. Bottom line, the cost of funds is not for free. So we are going to see distress in the market. But I will tell you this, there's 400 billion of capital, I think Cassandra touched on this on the fringe, sitting on the sideline. 250 billion of that wants to be or find a home in the U.S. It speaks to the safe haven that the U.S. is. It speaks to the governance that we have here. That capital's waiting to move until we see more transparency and more pricing structure in the marketplace. There are not enough trades right now in real estate for people to truly feel comfortable with where the pricing ought to be. I will say we've seen some of the big movers, the Blackstones and others, begin to make some moves in different sectors, be it industrial, be it multifamily, and other areas. Office will be the last to move, in my opinion.
Right. So have we hit the bottom?
If I only knew. The answer is I think that we all believe that we are getting close to the bottom. Probably we'll see it this year. At the end of the day, I think the headwinds that we're facing that really will determine this are three things: geopolitics, macroeconomics, And where we anticipated at the beginning of this year that the Fed would cut the rates somewhere around 150 basis points, maybe 4 or 6 cuts, we will probably be lucky, this is just my opinion, if we get 1 cut or 2 cuts, and that will probably come in the latter part of the year.
Right. Let's talk a little bit about the Big Apple. How's New York doing post-pandemic?
Yeah, look, I think New York is faring better than most of the major gateway cities. We've seen this return to work. It's probably higher in New York than in other places. I mentioned that the national average is closer to 52. Peak days, as I said, in New York were around 65% today. The bottom line is this. Young people want to come back to work. The work from home, the hybrid workplace that we see so much publicity about, it exists. It's real. But the truth is people want to be mentored. To grow your knowledge exponentially, you can't sit at home. You can't learn it from Zoom. You have to learn it from someone who's had the experience. So we're seeing more and more people come back. And I think in several years, we'll be talking less and less about the hybrid workplace and more about just being in the office.
What does foreign investment in New York City look like at the moment?
Well, so we are clearly off any peaks that we've had. There hasn't been a lot of significant moves. As I mentioned, most of the capital is sitting on the sideline waiting to go. I think next year, tail end of this year, as we get clarity on the interest rates, as we get clarity on where the market's moving and as demand comes back, you will see the moves made. So foreign investment right now has been slow, but it is clearly targeting New York, probably foremost amongst the cities in this country, primarily because this is a very robust market. This market is made up of legal, finance, tech. We are the financial capital of the world. There was just a major deal announced by a major institution on 350 Park Avenue for a commitment close to 1 million feet. That's what drives rents in New York forward. And so if you look at how rents move and if you look at how the markets move, I think that we're going to do fine, but we'll probably see that more next year than this year.
And just widening the lens a bit, what does the US economy look like from your point of view?
Oh, well, the first word that comes to mind when you talk about the U.S. economy is resilience. Everybody has been talking about a hard landing, a soft landing. I'm not an economist. Let's be very clear. I'm a real estate person. At the end of the day, when I listen to an economist, I say, I'm going to bet the opposite direction. So right now, I'm sorry. Sorry for all the economists in the room. I deeply apologize. But truthfully, I think that we are probably going to see a mild recession. We'll avoid, I think, a deep recession. I think the banks are working with their lenders. We know that there's about a $1.2 trillion of debt coming due. Most of that debt will be worked through on a short-term basis, but some people will have to put capital in. What I think will happen is gradually, as some of the geopolitical risk comes off the table, hopefully de-escalates, as we see the macroeconomic figures become more certain, I think CEO confidence will return. And so I think we'll see a mild recession, and the U.S. economy is tremendously resilient.
Right. Well, I guess we've got to talk about politics. So is the political climate, uncertainty about the election outcome and so on, making it harder to do business in New York City?
So I don't know what it is about New York, but I think that New Yorkers pay attention to the numbers less so than the politics. And you have seen decisions made, continue to be made in spite of the politics of the day. I think that in spite of that, we will power through that. I just don't see the politics holding back business decisions. That's going to be more of a geopolitical issue and more of an issue for our allies around the country to be concerned about as it affects our policies towards major important relationships like NATO.
Okay, so just a final question to take us into our coffee break.
Yes, ma'am.
Is looking ahead maybe 18 months, so beyond obviously the next election.
Yes.
What are your predictions? Few predictions.
Yeah, so it's and it's always nice to be asked to predict the future, because whatever I say, we don't know what will happen. But I think I would say two things. First, I think that from a geopolitical level, I'm looking for the conflicts to de-escalate. I think that everybody is at a place where we want to see things normalize or get to that point where they can normalize. Secondly, I think in the business world, the underlying fundamentals will change. We will never go back to a cost of funds that is at zero. We will be at a new level in cost of funds, and I think that will present unprecedented opportunities for wealth creation and for new investors to see new bases to drive their business forward. So I'm very optimistic about the future. There are risks. Clearly, there are risks. Everything I just talked about can impact it. But by and large, I think CEOs that are driving multinational companies look at the future with optimism for the reasons I've just talked about.
Great. Well, thanks so much, Bruce.
Thank you.
I certainly learned a lot. Thanks for sharing those
so
insights with us. And we'll have a photo and then we'll join us for coffee. Thanks.
Thank you so much for that. Thank you.